Hello, it is nice to see you for an episode of Lowcountry Money Talk. We've got Phil Bloyd with Revolutionary Financial Group at the desk once again. How are you?
I am great.
Good.
I hope you are too.
I am. You know what? I'm ready for the show today. We've got a lot to discuss.
Yes.
And when you were here last, Phil, we talked a lot about bear markets, looked at some historical data,
Right.
what we can expect, what we can deduce from some of these things, and then how to plan for our retirement and maybe make some adjustments. So quick review, and then I've got some questions to dive in.
I love questions.
So for our viewers who didn't see our last one, or maybe you did and want a little refresher, so the technical definition, of course, of the bear market is being down 20% from the high. So we know we're there. We've definitely entered the bear market, but let's talk about why is it that it's particularly devastating for those who are nearing retirement, who are in retirement, because it's not fun for anybody really, but for those folks, it's more challenging.
Right. So a perfect storm, I would say. So I'm in the retirement, I'm in a bear market now. Maybe I was overly invested in equities because they performed so well over the previous 13 years. So I'm like, oh, the good times are here for good. I forgot that I'm not saving anymore, I'm not working anymore, no more contributions, and then I have to do maybe required minimum distribution, so I have to take money out. You know, you always hear the term, well, it's only a paper loss. As long as I don't sell the position, I really haven't lost anything. Well, if I'm over 72, I have to take distribution, which means I'm gonna have to realize that gain or loss. So I'm gonna have to make that sell. So being a retiree, the devastation of a bear market is one thing, but when we add in recessionary problems and we add in inflation on top of that, then that's just like a perfect storm. So we have to be careful that we don't spend all of our money. You know, we're paying more for food, we're paying more for gasoline, more for energy, and yet if I'm overly invested in the market, maybe my assets are down 20%. So we have to be careful that we don't spend too much.
Yes. Well, and it is challenging to navigate as you enter, those years, because you may have been doing something for a long time and it may have been working okay for you.
Yeah,
and now here you really need to take a good look and maybe make some adjustments, and that can be tough for folks to do.
Yeah.
All right, another thing I want to discuss before we head to break, maybe we'll just sort of graze the surface here, is months ago when you were here on our show, you talked about stagflation.
Right.
And the potential that we might need to really understand what that is. So give us a refresher.
Well, most of our viewers, if not all, but most of our viewers will remember that. About 40 years ago, we had a stagflation problem. So stagflation means a period of time at high inflation and low economic input. So we're kind of there. I did mention a few months ago that we're going to find ourselves probably in that situation. And the upside is people still say, well, we've got a great job market, so how could we be in stagflation? I'm not sure we have a great job market, so I'm going to stick with that, because wherever I go, there's not people working.
I was going to say, ask any entrepreneur if we have a great job market, right?
They can't get help.
No.
So I think I also mentioned during the show, we were going over those things, that as we get into a recession, you're going to go from a point to where you need so much help that you have all the help wanted signs up, and then maybe people are running out of money because of inflation and higher prices, and they're ready to go back to work. But now all of a sudden those 11 million jobs kind of evaporate and they don't need you anymore.
Right.
So I'm afraid we might get to that situation.
Yeah, and that's obviously a concern as well, because if you're ready to go back to work and you're ready to start earning that income again, those jobs that you thought were so prevalent aren't available anymore. Right, okay. So how does stagflation, and this is too much to bite off in the minute we have left, but maybe we can do this when we get back. How does stagflation really impact our plans for retirement?
Well, Jessa, the thing is, people, when you retire, you need to be in the retirement planning. When you're working, maybe you're in financial planning, but you need to kind of know the difference. So one thing I always point out to folks that come to our seminars and events, and we'll be having one in August, so many people may be getting invitations or whatever, so you might want to call in on those. But you have to change a bit, okay? Because when you retire, like I said before, you don't have the income coming in, you're not making contributions, what you save has to last, and you can bet over your retirement lifetime that we're gonna have some bear markets. So the best way to plan for them would be now you plan for them ahead of time.
Yeah.
But now we are where we are, so we still have to deal with that. If you haven't, we need to get the plan going.
Yeah, so if you haven't done that yet, we're going to give you some ways that you can do that after the break, and lots more to talk about. Stick with us here on Lowcountry Money Talk, because I think Phil's going to stick with us.
I'll be here.
He sure will. We'll be right back.